First question is how to judge whether a balance sheet is a good balance sheet, that is it is a strong balance sheet, or it is a bad balance sheet, that is a weak balance sheet. Why this question becomes important? This question becomes important because, as we discussed last time, all the balance sheets prepared anywhere in the world will the asset side and the liability side of every balance sheet will always have the same total. And therefore, an obvious question that comes to mind is, if both the totals of all the balance sheets all over the world, irrespective of the product, the industry, the constitution, the nature, if the total of both sides are going to be same, then how do you figure it out as to whether it is a good balance sheet or it is a bad balance sheet? Now, friends, to answer this question, we will need primarily to look at three things. Of course, there are many things one can keep on discussing, but primarily to find out whether balance sheet of a company is a good balance sheet or it is a bad balance sheet, there are three things that we need to look at. The first one is we need to look at the figure of reserves and surplus. So, bigger this figure, better is the balance sheet of that company. तो the amount of जिस कंपनी का रिजर्व्स एंड सरप्लस का फिगर जितना ज़्यादा होगा उतनी अच्छी वो बैलेंस शीट मानी जाएगी और उतनी अच्छी वो बैलेंस शीट समझी जाएगी. एंड व्हाई इज दैट सो? दैट इज बिकॉज as what is reserves and surplus? Reserves and surplus is nothing but the profit earned by the company since its inception and plowed back into the business, and that is what is reserves and surplus. So what is the meaning of plowing back? Meaning of plowing back is company made profit and plowed it back. That means it has built more plants, more factories, it has gone for diversification, it has gone for modernization, it has gone for expansion, it has created more assets. So obviously जिस कंपनी के पास में जितने ज़्यादा एसेट्स होंगे, especially when those assets are coming from the profit that the company has earned, it of course indicates that this balance sheet is a good balance sheet, or this company is having a good balance sheet. So that is number one that we need to look at as to the figure of reserves and surplus. The number two that we need to look at to find out as to how is the balance sheet of a company is to look at the figure of debt equity ratio. Now, what is debt equity ratio? Debt equity ratio is the relationship between the debt of the company and equity of the company. And I'm sure, friends, we understand it very well. Debt, when a company takes a debt, it gets money, no doubt about it. It gets cash into the kitty of the company, no doubt about it. But when a company is borrowing, when a company is taking debt, together with that cash which is coming into the company, it gets two more things. And what those two more things are? Those two more things are that this company gets obligation to pay that debt back one day. And number two, the company also has to pay interest on that debt which the company has taken. And therefore, अगर एक कंपनी का डेट इक्विटी रेशियो बहुत ज़्यादा है, that means what? That means the amount of debt in relation to equity of the company is much higher. That means it is not a good balance sheet. Typically speaking, for a manufacturing company, it is okay to have a debt equity ratio of 2:1. For an infrastructure company, it is okay to have a debt equity ratio of 8:1. But let me also tell you at the same time, we can look at these ratios, a debt equity ratio, but it is more important to look at the debt equity ratio in the context of the EBITDA of the company. EBITDA of the company. So in general, अगर एक कंपनी का डेट इक्विटी रेशियो ज़्यादा है, that means this is not a good balance sheet. This is not a good balance sheet. So that is point number two that you need to look at. Point number three that you need to look at to find out as to whether the balance sheet of a company is good or not good, strong or it is weak, you need to look at the current ratio. Current ratio. Now, current ratio, friends, is a relationship between the current assets and the current liabilities of a business. So, generally speaking, remember, I'm repeating it. Generally speaking, a good current ratio is an indicator of good liquidity of the business theoretically, right? And therefore, the third thing that you need to look at is the current ratio. Of course, there is a contrary view about the current ratio, which I would discuss with you a little later. But for the time being, we just need to be aware of these three things to find out whether it is a good balance sheet or bad balance sheet. We need to look at three things. Number one, look at the reserves and look at the figure of reserves and surplus. Number two, look at the debt equity ratio of the company. And number three, look at the current ratio of the company.